Well, the selling has paused, but we haven't really moved to anything like a recovery. This is Macro Money. I'm Ilya Spivak, current head of global macro here at tastylive. Almost botched my own title there. And these markets today are licking their wounds, for lack of a better explanation. We have across all of the major assets a kind of quiet standstill after yesterday's crescendo. And the question, not surprisingly, on the minds of the trading public is surely, well, now what? So we've had this situation break out around the markets. There was a big sweep across risky assets. And we started the week with a bit of a reprieve in ISM service sector data out of the US. It was a little bit warmer than expected, suggesting it's not like the economy is falling apart tomorrow. But the rest of the calendar for the week looks relatively quiet, at least as far as US economic data is concerned. And so there is, not surprisingly, a kind of lack of conviction and a kind of reach for the next catalyst that is occurring all around, with everybody trying to figure out, okay, well, if the sell-off was caused by X, then maybe I'll look at Y for next steps. And if it was caused by something else, then maybe I'll look at something else. One very interesting bit in this story comes from China. About the most important bit of economic data on the calendar this week is a set of economic reports from, let's not forget, the world's second largest economy. And so the question that we have to ask ourselves perhaps is, could we get something from this data that helps the markets to find a bit of relief and a bit more upside conviction? Or will this be the next shoe to drop in the sell-off? And that's what we're going to focus on here today. So first and foremost, let's take a look at the expectations. And here things don't look all that terrible. The consensus for the trade balance numbers for July, that we're going to stay at a surplus of about 99 billion US dollars. Very little changed from what we saw in June. Exports seen accelerating a little bit, rising 9.6% year on year versus 8.6 in the prior month. Imports, perhaps most interestingly seen, rebounding 3.3% after a drop in June. That, of course, seems to imply that maybe we get something a little bit better on domestic demand. Later in the week, inflation. The headline inflation number, CPI, seen coming in 0.4% year over year. That's a little bit warmer than the 0.2% from July. Headline wholesale inflation, PPI, down 0.9% year on year. Still negative, but by about the same amount as we've seen recently. And perhaps this is really the story of this economic data. If we kind of take the two big releases here, the trade one and the inflation numbers, and we look at where the expected outcomes would fall relative to history, we can see here it's not a terrible departure. So the trade side of things, we can see well within the ranges that we've seen recently for year-on-year export and import growth. I suppose you could sort of envision a slight up slope here following the reopening from zero COVID restrictions in late 2022, early 2023. But really, the overall story seems to be of near standstill. We've gone up a bit, we've gone down a bit, but we're still kind of within the range of values that we've seen recently. It's a similar story for inflation. Yes, a slight pickup would give us maybe a little bit more confidence on this stabilizing. No, the PPI number going a little bit more negative wouldn't be the end of the world. It would sort of sit near some of these recent levels, having recovered from obviously much weaker readings earlier in the year. But overall, we're still sitting at levels that have now prevailed for quite a few months. And that is not good news for China's economy. I mean, certainly the CPI numbers probably tell the story better than anything that we see out of these figures. But as we've been talking about for a while, it's not just CPI. People have tended to dismiss the very low CPI numbers out of China because, well, nobody really knows the makeup of their CPI basket. The speculative sort of story, backed to some extent by Bloomberg data that does a fairly good job of guesstimating what the makeup is, says, well, so much of China's CPI basket is food, and food prices have been falling the world over for months now. That has led to significant disinflation in Europe, where that was the dominant source of inflation last year. Same thing for Japan, where that was a leading source of elevated levels last year. So we have a similar situation. There's nothing to worry about with this CPI data being so close to zero. This is just food prices falling away because they are so overstated in the Chinese consumer price index model. Well, not so fast. Because as we've said here quite a few times on Macro Money, and as you can see on the chart in front of you, the situation in China is economy-wide, and it is much less encouraging than the don't worry about CPI explanation would suggest. For 4 consecutive quarters now, 5 actually, now that I look at it, we already have the second quarter data out, and for 5 consecutive quarters at this point, real GDP, which is this red line, is above nominal GDP, which is the yellow line. Why is this significant? When you do the calculations and you say, what is nominal GDP? It is the overall output of the economy. What's real GDP? It's nominal GDP minus inflation. So you essentially say, well, rising prices might overstate GDP. And you want to get at what real growth is because you want to factor that influence out and see how much actual demand do you have. So what is it that we see here? If nominal GDP, the yellow line, is lower than real, that means nominal, the yellow line, minus inflation gives you a higher number. The only way that works is if inflation is negative at an economy-wide level. And what you see in these bars here is that you're talking about something to the tune of 1.5 percentage points of GDP growth, negative, which multiplied over the world's second largest economy is a staggering thing. Because what it's telling you is the entire economy is basically on discount. Now, normally, when there is rising demand, that demand competes for what supply there is, which creates a bidding up of prices, positive inflation. Because there is, at any given time, some degree of scarcity of supply given demand, which is growing, and people compete on price. This is good. This is why most central banks target some positive level of inflation. That is a sign that there is positive demand in the economy, which is consistent with growth. When you get the opposite, what you're saying is there's more supply than there is uptake from demand, and so things have to go on discount to get that supply absorbed. That is an economy without demand. for the most part. Now, you already see that in Chinese economic growth numbers. These are official figures. So if you are one of those people that worries about China massaging numbers, making them look better than perhaps the economy warrants, consider what it means that these are the figures we are getting through a rosy lens. But even if you take them at face value, they look as though the economy is stalled. So going back to where we had a bit of a pop in the first quarter of the year, since then you've had a steady slowdown in service sector activity, a steady slowdown in manufacturing sector activity, whereby manufacturing is now below this 50 boom bust line. As ever, this is in the logic of PMIs. So below 50 is contraction, above 50 is growth. Services, we can see, is still narrowly above 50, but it is so close to it that the sector seems to be almost completely stuck at standstill. And the situation in manufacturing is actually that going back to perhaps April into May, we've slipped into contraction territory. So manufacturing in China, that would be that export sector where we just saw, oh good, exports look like they might rebound here a little bit more. Well, not exactly the most encouraging thing when the manufacturing sector, the engine for export growth, is shrinking. And so we have a situation where the economy looks still terribly anemic. At the same time, the authorities seem to be doing a relatively poor job of generating some amount of stimulus to improve the situation. We see here the Bloomberg China Credit Impulse Index. This is new loans as a share of GDP, to essentially say, well, how much GDP is being created by new credit being taken out? And therefore, how good of a job are officials doing in stimulating that credit, stimulating economic activity, much like the Fed might with cutting rates, or the fiscal authorities might by dropping a ton of demand on the economy from government purchases. Well, that's clearly not working here because what we see is that the credit impulse index, the level, is now at some of the lowest levels that we've seen since back before COVID. Furthermore, the most recent months here actually have it shrinking in year-on-year terms. So we're looking at a situation where the economy is weak and the authorities are not doing a good job or a sufficiently potent job of restarting momentum. Perhaps not surprising within that context that foreign investors are fleeing. These are numbers from China's Ministry of Finance. So again, imagine if this were shaded to be rosier than it actually is, or take it at face value. Either way, it looks like there is a dramatic outflow of money out of China's economy, as its inability to reboot growth sends investors packing. What's more, all of this would just be baseline. This is just status quo. But it could be worse than that. Looking at data from Citigroup, we see that economic outcomes out of China have increasingly soured relative to forecasts. So if the forecasts give us, give or take, status quo, the risk is that we get worse results than even that, and the status quo is bad enough. We can see here the index as of June going into July has slipped below the zero line, which means not only are these data outcomes getting closer to forecasts and losing their ability to surprise higher in size, that would be this move here, we're moving lower, but we're still above this zero line. Now we're well below that zero line, suggesting data outcomes are actually tending to disappoint out of China. And so we might get numbers here that are even worse than the already anemic status quo, which of course comes at a most inconvenient time. Let's remind ourselves, global GDP is basically broken out into two halves. One half are three big economic engines, the US, the Eurozone, and of course China. The other half are, for the most part, vendor economies that are dependent on demand from the former three in order to have growth. So think about even some G10 economies like Canada, some European G10 economies like Norway, like Sweden, like the UK. A lot of these economies depend on demand from the Eurozone or demand from the US. In the case of Australia or New Zealand, again, G10 economies, there's a dependency on China. Never mind emerging economies or frontier economies, which are even more dependent on external demand. And so you have a situation here where at face value, the big three account for 50% of global GDP. In reality, they're responsible for a lot more than that, because the rest of the world needs them to be demanding things in order to generate demand of its own. We already have Europe, where growth has fizzled after a shallow recovery from a recession in late 2023. The data coming in for China seems like it'll be telling us a story of an economy still struggling, still pinned to the mat, if not worse, if those surprise index numbers hold. And where the positive story for global growth really through the course of this year and going back into last year has been a resilient U.S. economy. But just now, the markets are, of course, imbued with the idea that finally, the Fed is telling us their perception of the situation is that balance of risks that they face has shifted from just inflation to now growth and inflation. This is the story that the Fed has been telling us since the beginning of July. It has been backed by significant hard economic data, be it CPI or the most recent jobs report. And the markets have fully loaded up a rate cut of some amount, either 25 or 50 basis points, after yesterday's theatrics in the markets leaning toward 50 basis points in September, which is suggesting the one pillar of growth that was offsetting weakness elsewhere is now finally starting to go the other way. So a weak China here is just another reason to be concerned, because the world is effectively operating without a safety net. If the U.S. is indeed slowing, as some of the recent data and Fed commentary suggests, it isn't just a U.S. downturn we're looking at, but a global recession risk that starts to get a lot more acute. Consider, looking at global PMI numbers, we already have a significant shift downward in performance. We can see there manufacturing shrinking the world over as of the most recent data. A slowdown in services, although the most recent month, July, we had a little bit of a stabilization there, but the overall global composite has now been cooling for 2 months. So it's not like we're speculating that maybe global growth will start to slow. It is slowing. Furthermore, economic surprise trajectory for the world is down, and again, below zero. So generally, the path for global economic data is now skewed to weakness. All of which suggests that not only are we now in an environment where the US is rolling over, or perhaps looks like it might, on the business cycle, but it is happening at a time when the other major engines of demand are unable to offer any kind of a meaningful backstop. And to the extent that this Chinese economic data that we're expecting to hit the wires this week reinforces that perspective, we might again be reminded, well, here is a set of economic numbers that suggests this is not going to get any better because China is going to step into the breach and say, well, the US might be cooling, but at least China is finally finding its legs because export numbers are a little bit higher, import numbers are a little bit higher, and inflation numbers are perhaps a little bit less negative. No, instead, this data might well reinforce the idea that a coordinated global downturn is in the works. And it is certainly not irrelevant to point out here that while all of these rest of world economies are dependent on these three engines, China itself is not exactly a generator of independent growth onto itself. It is, for its own demand, dependent on demand from the US and the Eurozone. And the story there since COVID has been increasingly negative. China has lost a large share of the market as a kind of middle of the supply chain value add center through the pandemic. First, because it stayed closed with zero COVID restrictions much longer in there than in Europe or the US. That, of course, gave us, at least in part, some of the inflation that we've seen of the transitory supply chain disruption variety, much of which has been squeezed out long ago. But China has looked no better for it. It hasn't reshaped its mix of value add output. It has not reclaimed in earnest its share of those trade flows. It looks increasingly like the damage is permanent. It stayed closed for so long that a lot of the geopolitical desire to diversify away from China, evident in rhetoric from all sides of the political spectrum in the US, in the Eurozone, and elsewhere amongst the major economies, you have then a situation that, of course, encouraged diversification. And so if the Eurozone situation is again weak and the US situation is becoming increasingly weak, China's ability to offset that weakness is inherently undermined because it too is dependent on their demand. And it has already suffered a big hit to it that's probably structural. And so in looking at this data this week, the markets may well find yet another reason to think, well, maybe a global recession is at this point unavoidable. Whether they choose to sell on that news, because of course weakness in China is not exactly a novel thing, as we've just seen, that remains to be seen. But if the data surprises to the downside by a sufficient margin, as this would imply here, then perhaps the level of concern is ratcheted up once more and stocks swoon again. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where it might lead things from there. I'll be on with Victor Jones for the Price of Truth tomorrow, as I am every Wednesday. Back on with Chris for Futures Power Hour on Fridays. On with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. And opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.